Welcome back to Investment 360. Now, the Canon Equi-weighted portfolio is invested across the four main asset classes of equities, property, bonds and cash, with each asset class allocated 25% of the portfolio. Despite the asset class mix, the fund has performed in line with equities at a third of the volatility. Andrew continues his discussion in studio with us to talk about the construction of this portfolio. So why is the relatively low volatility relevant?
I think this is a great portfolio. I like to refer to it as a cockroach approach. The cockroaches can survive anything, likewise so can this portfolio. If you look through 2008 with the crash, when you've got a mix of asset classes and at equal weighting, you tend to be able to manage or the portfolio manages to get through the cycles or different cycles very well.
You can hedge all your bets.
Exactly. So we tilted slightly around. We'll tactically allocate around the 25% strategic asset allocation to try and build some alpha into the portfolio. And then obviously we've got the underlying stock picks that will also hopefully deliver some alpha to the portfolio. This portfolio is about 7 years old now, and it's performed exceptionally well, and we're about to launch it into the retail space.
Andrew, you got 25% before we get into the stock picks. What have you done with the other three baskets, the property, cash and bonds? What do you use in each of those three portfolios?
So cash is a normal money market fund, unit trust, and then within bonds we use an ETF. We don't see ourselves as a bond investor. We don't think we've got the necessary expertise in that space. So we use an ETF. We can value the bond market and we can see when it's offering value or not, but we don't look at the yield curve to try and determine whether we should go for long duration or shorter durations. So we just, our bond exposures through an ETF. Equities and property are then, we build bottom up stock picks as we would for our house view portfolios.
Just talking about the listed property, obviously with listed property yields tracking those of bond yields, is it a good time to be buying listed property at this point?
Yeah, I mean, that's obviously the risk at the moment. We were overweight property last year, so we did very well from that exposure. Right now, we brought it down, that risk that you highlight with the bond yields. Yeah, we're a bit nervous about that, so we are underweight property now.
So looking at your equity allocation, what are we seeing there in terms of stock picks? It'd be a little specific.
So within our equity space, we obviously take a top-down view on the sectors first of all, and as I alluded to earlier, I think we've seen value within the resources. Financials are looking slightly on the expensive side, and the large cap industrial is very expensive. So we underweight financials and industrials, overweight resources. So within resources, we like the diversifieds in particular, and these include the likes of Anglo American, African Rainbow Minerals. We then got some gold exposure through PanAf. Sasol is another company that we own there. Within the big banks, we've got Nedbank. We think Nedbank's probably the most attractive bank at the moment.
Not ABSA.
We've held ABSA. It's between Nedbank and ABSA at the moment. We've held Nedbank for a long time.
I can see the tussle going on there.
It's trying to work in my mind, yeah. ABSA's looking attractive, and we've been sniffing around it. We haven't bought any yet, but it definitely is on our radar screen at the moment.
Is Nedbank attractive just because of the valuation?
Yeah, it was. I think we've held it for about 4 years now, and we bought it, I think it was under 100 Rand. And yeah, it was exceptionally attractive. When you look at the likes of First Rand, this is the bank that everyone loves at the moment. If you exclude Capitec, when you're talking the big four, they've done exceptional things, and we see these multiples. I think it's a price to book of 2.5, and then you compare that to a Nedbank right now. I wouldn't say it's exceptionally cheap or attractive, but on a price to book of 1.7 and a return on equity of 20%, we think it's offering some good value.
Any discussion around Standard Bank? In terms of if you're looking at laggards in the sector? Yeah,
Standard Bank hasn't performed well. We hold Standard Bank in certain places, not in our house view equities, but in portfolios that have more financial exposure, and we hold two banks. Standard Bank is in there. Yeah, that is a bit of a lagger. Hasn't performed as poorly as ABSA, but yeah, we're not overly enthusiastic about it right now.
Andrew, just to take a step back, you mentioned that you get your exposure to gold through Pan-African Resources, which is very much a small to mid-sized gold mine, and it's got some other things now. Why? This is the ultimate value trap. The large gold companies, are they value traps, or what's going on with them? Because some value managers love the gold shares, but just have had misery for the last 3 years holding them?
Yeah, I think gold companies as a whole, if you look back through history, have been poor allocators of cash. I think they've raised more cash than they've given back to shareholders. So when you talk about nationalisation of mines, this is exactly as South African Airways, where you got to just continuously put in money. These shares haven't performed well. Junior gold mine is probably, people would raise their eyebrows and say, "She's, gold is risky. Now you're going for
now
junior."
You're going for the junior miners.
Exactly. But we think PanAf's a fantastic little business and have done exceptionally good things. They've moved on to become a producer recently. Well, over the last 3 or 4 years, they were firstly just an exploratory business, and they've just done that Evander acquisition. So they've doubled their gold production. And we think that's a great little.
But how does it get you to deviate from your philosophy? Because you're a stickler for your stringent, deep value philosophy. If you can clump all the gold stocks together and say, listen, these are value destroyers, they have been historically, how can you take an exception to that rule?
When you look at PanAf over the short history that it has, it's done some exceptionally good things. It's a very good dividend payer. It raised capital now for the Evander transaction, but they haven't had to go to the market beforehand. They've got an exceptionally good balance sheet. They've got next to no debt. They've raised a little bit of debt now for this Evander transaction, but when you looked at them, or when you brought in, there was no debt on this balance sheet. So it's an exceptionally well-run, high-quality business, good management team in place that is very familiar with their assets. And they're a low-cost producer.
Couldn't you say the same about Capitec?
I was about to say the same thing.
We're on the same page. You're not getting off the hook like
Yeah, sure. But then you got to go. Then you got to go and look at the valuation as well. And Capitec's valuation is not quite what we've seen at PanAf. Not that you're going to value those two businesses the same. They're very different, obviously.
Andrew, Jan's moved on. The CEO that built that business. How do you take that into account in assessing a company? Because that is a key.
Yeah,
one of the key determinants of what happens to the company.
And we didn't see that coming, and we've met with Jan quite a few times. We've tried to get to the bottom of what really caused him to leave. He cited personal issues. We don't know what that means, but obviously that's not good news. And we saw the share price react when that announcement came out. However, the rest of the management team remain. They were equally integral in building this business as Jan was. So we've got confidence within the guys that remain there.
You've done quite a lot of work around the construction companies, and in that intro we had a graph that described the difference between the CAPE ratios of construction companies in 2008 when they were in the 30s and the 40s versus where they are now in single digits. It's the ultimate boom to bust industry. What construction companies do you own?
At the moment we've got Avenge and Group 5. We've held these companies for some time, and everyone knows what's happened in construction. So it's been a rough ride. The last 6 months they've started to perform quite nicely, and we're looking at the construction results that have come out. It looks like we passed the worst, touch wood, but we're starting to see some decent numbers coming out of there, and the share prices have reacted accordingly. We think the whole subsector is looking quite attractive. However, there's some good quality companies in there, like Wilson Valley Homes, and there are others that are not so good quality that we've got to steer clear of. The sector as a whole is looking quite attractive.
Should we get him to name the companies that aren't the good ones, or should we put them on the spot?
Name the ones that aren't the good ones. I'll tell you what, I've got one better. As we're going into a long weekend now, what is the stock that, as you walk into Canon Asset Managers at the moment, is the hottest pick around your boardroom table?
As sexy as it gets for Canon Asset Managers. I know you guys
exactly,
like the
in the
super
deep value space.
Jeez, that's a very good question. I think a Pinnacle Technology would spring to mind. Pinnacle is also, it's just a great quality business, and when you look at what that management team's done with that business, they're quite acquisitive, which we don't generally like, but they've proven to be very good at making acquisitions, and they're good allocators of capital. Looking at their metrics, I've got no idea why a company like this trades on a single-digit PE ratio when they've just grown earnings in excess of 30% over the last 5-6 years. We bought them at about 8 Rand. They're now sitting well over 20 Rand. So this company's, done phenomenal things. It's a great little business, and it continues to offer values.
I think a rich hunting ground for most investors is the smaller, mid-sized cap side of the market, just because it doesn't receive the kind of attention that large caps get. Are you still seeing plenty of opportunities generally in the small and mid-cap space?
Yeah, as some of the shares that I've mentioned, you will have picked up. We've got a lot of smaller companies in the portfolios. This is the beauty of being a small asset manager. You can go deep into the markets. It's not just a function of we can go deep. That's where the value is at the moment, and we've seen it in the graphs. When we looked at the large cap industrials, they're expensive. These are the companies that everyone loves to talk about, loves to own, and kind of the small ones generally get ignored, specifically by institutional investors, because they're too big to go there. You try and buy 1% of your portfolio, you're buying the whole company for the bigger guys. So it's a great opportunity for us. That's why we like being small, and I guess that's the boutique asset management model.